Good morning. Welcome to America First Wealth Management Investment Outlook for November 11th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First. Today is Veterans Day. I want to wish all the veterans and their families for their service and thank you. Stock markets are open today. Bond markets and banks are closed. This is our standard disclaimer. We're not offering to sell any securities. We're just offering our opinions as of the current date, and our opinions are subject to change as market information and data changes. So we like to begin with our conclusions and outlook first, and then additional supporting data next. So this week, last week, we certainly finally understood what Kamala Harris's trademark phrase, "what can be unburdened by what has been," has meant for the markets. Certainly after the Trump victory, the S&P 500 index and Bitcoin has hit new record highs. And we feel that there's more to come, at least until year end. The question mark is, what's in store for us for 2025? Certainly stock market valuations are extended. I'll have some data on that. Question on inflation. We can certainly expect lower energy prices given Trump's mandate to drill, and there should be a multiplier effect that will lower transportation and cost of goods. However, labor costs and service inflation will likely remain sticky. So we don't know what the net will look like for inflation next year. In terms of jobs, we're likely to see losses in the public sector as Elon Musk is appointed as the cost-cutting czar for the Trump administration, and it will likely be losses in jobs in the public sector. And we do expect to see some increases in the private sector, but we don't know what the net effect will be. For both consumer and corporate segments, we do expect to see lower taxes. For the consumer, we expect to see increases in discretionary income and spending, certainly as policies that Trump had called out, such as no taxes on tips and overtime, work its way into increased consumer discretionary income and spending. On the corporate side, lower taxes. Obviously, Trump wants to lower the corporate income tax rate all the way down to 15%. Well, what will companies do with the increased cash flow? We're uncertain as to whether or not they're going to increase CapEx spending, R&D spending, hire more workers, or will they engage in M&A activity with certainly lower taxes and reduced regulation? Or will they also simply just increase dividends and share repurchases, which have the effect of increasing stock share prices, but what will it do for the economy? GDP growth, we expect to see increased growth from increased spending both from corporate and consumer end. But what's that going to do to public debt? Will income tax revenue increase from higher GDP growth, or are we going to see higher public debt? Certainly, fiscal spending has been out of control, and we'll see what happens net. We have cuts planned, we have stimulus by lower taxes, but the overall effect will be uncertain until we see these policies start playing out. Also, there's a big question mark in our mind: what will be the effect of higher trade tariffs, particularly against China? Will that end up raising consumer prices, sparking higher inflation, or will foreign investment in the U.S. increase as they realize that instead of producing goods overseas and shipping it here, they may decide to increase investments in the U.S., open up factories, and increase hiring here to produce their products here to reduce the burden on increased tariffs. So those are questions we have for 2025, and we'll pay close attention to see how consumer, corporate, and foreign companies react to changes in policies. Turning to S&P 500 earnings, they are lighter this week. Tuesday we have Home Depot and Tyson. Wednesday, Cisco, Bed Bath Beyond, and Copart. And Thursday, Disney and Applied Materials. I do want to point out on the 20th, NVIDIA does report, and that I think will be the big earnings report everyone's looking for the rest of this month. Big drivers for the market this week are clearly the macro data points. Coming out Wednesday, 8:30 a.m. will be inflation numbers. And then Thursday, we have PPI. And Thursday, 4 p.m., Jerome Powell will be giving a speech. We'll be paying close attention to that. Friday, 8:30 a.m. will be retail sales. We do expect all of these key macro data points to be market movers and anticipate higher volatility. So, quick summary. Trump's victory was clearly, it wasn't a landslide, but it was certainly extremely strong, winning 312 electoral votes and a majority of the popular vote. So we haven't seen that type of victory in both for the Republicans, for the Electoral College and the popular vote since 1984 when Ronald Reagan beat Walter Mondale. So it is a historic win, and certainly what can be unburdened by what has been for the last 4 years, the people have spoken, and the markets have reacted very positively, which we take as a very strong sign that investors do feel that the Trump victory will be beneficial to the markets. At least that's for the short term, we believe. And again, we do have a lot of questions for 2025, and we'll wait to see how things play out. Turning to the weekly market stats for the week ending Friday on November 8th. Clearly very strong markets, Dow, S&P. Small caps notably were up over 8%. A huge increase in small cap, big rally for small caps as investors rush to take higher risk. The only major index that was down was the MSCI EFA. Bonds also rose as interest rates fell, both triggered by the Federal Reserve rate cut the day before the elections, and also after the elections when the 10-year bond yield dropped. So clearly a very strong week, and we do anticipate the rally to continue, notwithstanding any shocks from macro data or any other potential surprises that may happen. Magnificent Seven, obviously the big victor among the Magnificent Seven was Tesla, up 29% for the week. Obviously, Elon Musk clearly has recouped huge benefits from supporting Donald Trump, and clearly the stock is a huge winner. So Tesla is a name that we do continue to like, and everything else pretty much followed suit. Very strong week, nothing much to say, but certainly a record week for the stock market and the Magnificent Seven names. Sector performance, consumer discretionary was the big winner for the week. Energy sector was strong, and pretty much we saw everything very solid for the week. And the laggards were the more defensive names, consumer staples, and utilities, but very solid week, posting strong gains across all sectors. S&P 500 rose to a record high, um, over 6,000 currently on Monday, and clearly um, very strong. I do want to caution that the RSI is now entering into overbought territory. So we don't expect things to go straight up, although we do expect the markets to continue to be robust through year end. There will be some moments of volatility, and we're all going to enjoy the ride, but it's good to throw in some caution when we see movements like this. Treasury yields dropped, 10-year Treasury yields dropped 7 basis points last week, and we're still up 42 basis points for the year. We're slightly below the 10-day moving average. Would like to see the Treasury yields continue to drop, but that's going to be a function of what inflation numbers look like. And as I mentioned, inflation number this week will be very critical in terms of the direction of interest rates. Here's the yield curve, and we have November 1, the last 2 weeks on top, and the last, I think, third quarter. We do see a rise in the yield curve. We still have an inversion, but it's kind of like a squiggle, and we do expect to see hopefully short-term rates drop, and we'll see what happens to long-term rates. We'd like to get back to a normal yield curve, but that could be longer rates going higher and shorter rates dropping. We'd like to see longer rates stay where they are and short rates dropping to get back to that normal positive slope yield curve, but it's going to be a function of what inflation looks like. Turning over to the economy and stocks, this was an interesting chart that Goldman Sachs put out recently. Americans are holding record shares of their assets and equities. So it's clear that the stock market is the driving force in the economy now. And if stocks continue to rise, we should hopefully see consumer spending increase as stock market fuels spending. Equity fund flows were at records right after the election, so a very strong week. Inflows, there's been, as noted before, there's a lot of cash sitting on the sidelines, so that money is rushing into the markets and driving up equity share prices. This is a relative performance of small cap S&P 600 versus S&P 500. We have huge relative outperformance in small caps for the week, and this is an interesting chart that shows relative outperformance by small caps that wasn't explained by higher earnings for small caps. So this was obviously a Trump victory driven event for small caps. Any further increase in small caps relative to large caps should hopefully be driven by earnings increases, which we think is probably a tougher slope to handle because small caps are, as we mentioned in last week, small caps are and small companies are hurting by the higher short-term interest rates that's burdening their small company cash flow. But obviously, last week's Fed rate cut on short-term rates will give small companies some breathing room. So we like the direction. Hopefully that translates into increased earnings as well for small companies. Turning to some charts where we talk about valuation, the equity risk premium, which is the earnings yield, the earnings per share of the S&P divided by current price, versus the 10-year Treasury yield. And that equity risk premium, earnings yield for the S&P versus 10-year Treasury yield, That's at its lowest level in 22 years. So basically what this is saying is that owning bonds is probably more attractive than owning equities just on a yield basis, earning yields versus treasury yields. So this is an indicator we think that flashes a warning. We do want to note that last week we talked about Warren Buffett, Berkshire Hathaway's record cash hoard of 325 billion, and being the classic and consummate master value investor, Warren Buffett sees these valuations and is opting to stay in cash for now. So whether or not there's a correction coming remains to be seen. But clearly valuations, according to the equity risk premium, is very low, and it is flashing a caution sign. And as I mentioned last week, Berkshire Hathaway's cash holdings is a good warning sign, but it's been a bad timing sign because he's been raising cash for the last 9 quarters as the S&P has gone into record territories for the last 9 quarters. So sorry, Warren, you missed out on that move by sitting in cash, but we know that cash is not burning a hole in your pockets and you're waiting for better values. Looking at PE ratios, forward PE ratios in particular, we're at the highest level since April of 2021 at 22.2. Also, 10 of the 11 S&P sectors are trading at multiples that are over their 25-year averages. So yes, things are expensive, but that doesn't mean that we're going to crack or have a crash simply because things are expensive. It just means that the difficulty of going to higher highs is going to be a lower probability. As long as investor sentiment and interest rates continue to drop, we can likely push to even higher highs. But we do have to recognize things are getting more expensive. So we're flashing a warning sign, but not a timing call to sell stocks. This is a chart on inflation expectations, which we feel is positive. 1-year expectations fell to a low of 2.6 for inflation, while 5 to 10-year expectations edged up to 3.1%. So clearly the expectation for inflation is trending in the right direction, and we're sure the Fed is aware of this, and which has led to their last 2 rate cuts here. And so hopefully the previous rate increases are working their effects, and we'll continue to see a drop in inflation getting to their 2% core inflation number, which will be evidence of achieving a soft landing without the economy going into recession. Closing out my comments this week, gold, and really this is more comment on popularity of Bitcoin versus gold. BlackRock's Bitcoin ETF now has more assets than their gold ETF. And this is the first time that's ever happened. And largely driven by Trump's promise to want to make crypto prominent in importance, and that the U.S. should have a leadership position in it, potentially even setting up a strategic Bitcoin reserve. So it's clearly evidence that the Trump administration recognizes the importance of Bitcoin and possibly crypto, and the U.S. should be a leader in it. So obviously a lot of investors, especially the younger generation, is putting a lot of money into crypto and Bitcoin. So that's, we expect that to be a fundamental policy decision that should be supportive of crypto. So while we are stock investors and not crypto investors, We do acknowledge this, and there also are some interesting stock investments that participate in the crypto rally, and we feel that these also have more room to run. And with that, that closes out our comments for this week. And if anyone of our followers and listeners would like more information, please feel free to contact me or Jim Monahan. Our emails are listed here. Would love to set up one-on-one calls with you and address any questions and specifics you might have. So thanks for tuning in today. Have a great week, and once again, happy Veterans Day again. And thanks for your service for all the veterans and their supporting families. So enjoy the day, enjoy the week, and we'll see you again next week. And thanks for tuning in. Take care.